Hello everyone. Today we have Mr. Vetri Subramaniam, who is Chief Investment Officer of UTI Mutual Fund. He has over 30 years of work experience in the capital market. He has previously worked in mutual fund companies like Kotak Mutual Fund and Invesco, and for last 7 years he has been associated with the UTI Mutual Fund. First of all, thank you so much for giving us the time from your busy schedule.
Thank you. Pleasure to be here.
Yeah. So, my first question is regarding the philosophy of UTI Mutual Fund. Each organization has its own core philosophy and work pattern. So, what you have seen or what you have established in UTI for past 7 years, if you can highlight upon those things.
Sure. So, two things I would say. One is obviously, UTI is, in a sense, India's oldest investment institution. So, there has always been a culture of having a strong in-house research process.
Okay.
So, the culture of doing research on stocks in UTI goes back, more than 30 years or more. So, that culture has always been there. I think when I came on board in 2017, the attempt was to build on top what was already there as a research culture, and we implemented what we call the Score Alpha process for investment management on the equity side, and later we have also implemented what we call GIMS on the fixed income side. The purpose of having these processes is that it ensures that whatever activity is happening on the investment side, it is driven by a process. Any investment team, like any sports team, will always require good team members or good players.
No.
But the process is what actually serves as the operating system of the team.
Yes.
It serves as the basis of how you actually carry out research on individual stocks. It also serves as the basis on which you go about building portfolio construction.
Right.
So the Score Alpha process covers both the research process as well as the portfolio construction process. And it also lays down what we call are the guardrails. So every portfolio strategy that we run has certain guardrails, and those guardrails involve the kind of companies that you buy, the kind of exposures that you run, the amount of risk that you take. Each of the strategies has a very different approach.
Right.
So that is the final thing that I would say. In UTI, we have one investment process, but we don't have one investment style.
Okay.
So we manage strategies which have very, very different styles from each other,
Okay.
but all of them are supported by the same underlying investment process, and each of them has their own governance guardrail. So I think that is what actually we think will make a difference to our investors, because that gives you a process which can be part of the customer's investment journey for 10 years, 20 years and 30 years. Because just like a Microsoft operating system, it can keep evolving, but it gives you continuity of experience.
Yes.
The same thing is that the investment process can give you that continuity of experience.
Yes. Looking at your 30 years of past experience, you must have seen various sorts of companies getting listed. If you talk about the companies getting listed 25 years back, companies getting listed 10 years back, and the new age tech companies. So, what have you seen? What change have you seen in those companies in terms of maturity, in terms of corporate governance, in terms of their ability to improve the market share,
Right.
and their profit generation?
Sure. So I would say the biggest change which has actually happened is that if you go back 30 years and maybe even before 30 years, because I used to see when my father used to invest in lots of IPOs at that time, public issues that we used to call it, companies used to come to investors at a very early greenfield stage.
Okay.
I have this plan, I'm going to build a refinery, I'm going to build an aluminium plant, I will build an oil plant, etc., etc. And you take money from investors at that very early stage. So in a sense, investors are participating in the entire project risk, so to speak.
Yes.
What has really changed over the last 30 years in particular is that you have the entire rise of a private equity and a venture capital funding system, so that when these entrepreneurs have business ideas, and maybe their business ideas are no longer to do with refinery or steel plant, somebody wants to do a B2C business on technology, somebody is doing an internet portal, whatever it might be, they are getting funded by PE and VC. So the risk capital in the very early part of their journey is given by those investors. And only when the business model has actually matured up to a point, they then come to the capital market.
Right.
So in a way, these businesses are coming to the market at a slightly more mature point. Also means they may be coming at slightly more premium valuation, because now they have already covered some part of their journey as a private company, which previously used to happen as a listed company. But I think as a result of that, actually you tend to see a lot more companies which have already demonstrated some credentials in terms of the business model that they have built, in terms of the growth that they have achieved, and they have already been exposed to external governance. Because if you take money from a PE or a VC, they will come on your board, they will expose you to best practices. So the companies are better prepared when they come to the public market for wanting to deal with public market. Having said that, one thing does not change. In the IPO market, and I would say in all investing, what is always true is the principle of buyer beware. Right? In college, they taught us caveat emptor.
Yes.
Right. In a IPO, caveat emptor is even more important than in a secondary market trade. Because when we go to the secondary market, we can see 20 years of a company history. We have maybe 10 years or 20 years of experience of talking to this company and how they sort of conduct their affairs. In an IPO, you get maybe 3 years of data, 5 years of data. You have never spoken to that company before. You get 1 hour to meet the company before they come with the IPO. So the amount of information available to you when you invest in an IPO is always much lower than what information you have and knowledge you have about a company which has been listed for a long time. Therefore, I always believe that IPO investing by definition is more risky because you have less information.
Yes.
Not because it is risky, because you have less information. And therefore, in IPO investing, buyer beware is always the most important principle.
True. So as we discussed, the nature of companies which were getting listed 30 years back and now are different. But what we have also seen that the behavior from investors' side is also getting changed. 30 years back, they were trading in paper. Then the evolution of demat came, and now investors have gone into F&O tradings and day tradings and lot of other things. And if we see that if someone has remained in the market silently and peacefully, he has already gotten handsome returns of 14-15% CAGR by just staying in the market. So how do you evaluate these two scenarios, and if you were to given a chance, what kind of advice would you give to such kind of people?
No, so I'll just correct you on one thing. One thing has not changed in the IPO market from 30 years ago to today.
Yes.
Lots of people go to the IPO market for one reason: they want listing gains.
Yes.
They think this is easy money.
That has not
So
changed.
that has not changed. That behavior is the same.
Yes.
When they think there is listing gains, they will all queue up for IPO. So that doesn't change. That has not changed. That is part of their behavior. You're also right about F&O and trading.
Yes.
This again is very cyclical. When I started, we have seen lots of people in the Badla trading days in the BSE in the 90s.
Okay.
Then the boom in F&O and margin trading which happened in the 2000s. Now, of course, it is an option-led trading boom which was not there in the previous cycle. But people always have this thing of looking at markets as a get-rich-quick scheme. It is not a get-rich-quick scheme. It is where you invest your savings for a future return. It is not a get-rich-quick scheme. I think it's a get-poor scheme if you use it with leverage and you use F&O. So I would always caution people to be careful about that. You talked about sitting patiently. As I said, if you sit patiently in equity, and the data is telling us, right, there has been money that you can make over the long period of time. The price that you pay for earning that return is you will have to tolerate volatility. So be prepared to tolerate volatility. Be prepared for the fact that the returns are not linear, which means a lot of the returns can come in a brief period of time, and then there can be long periods where there is no return. But over the entire journey, you still end up making a reasonable, kind of return. So I think patience is what is the most important criterion. And what I always tell people is, when you think about the investing journey, you are thinking about the compound interest formula. And when you're thinking about the compound interest formula, the two, variables are R, which is your rate of return, and N, which is the number of years.
Yes.
Actually, the most powerful variable in that is N, which is the number of years, and not R, which is the rate of return. But people forget this. And I think that is the main message that I would want to give people, that focus on the N, because that is what creates a disproportionate outcome. Just to conclude on that,
Yes.
Most people have heard of Warren Buffett, multi-billionaire, among the 10 most richest people in the world.
Yes.
But he became a billionaire only at the age of 58. So today, at the age of 90 plus, if he is worth 100 and something $billion, almost closer to $200 billion, it is only the benefit of compounding from being $1 billion at 58.
Yes.
So if you are not 58 and you don't have $1 billion, don't worry, there's still hope for you.
My last question to you is, a lot of investors make definitions on their own experience of words like diversification and asset allocation. Every person or investor goes through different kind of experiencing of different asset classes and then makes their own definition. So from a fund manager's point of view and from a veteran point of view, if you wish to clarify on both definitions of diversification and asset allocation to our investors, that would be really helpful.
Sure. So I think when we say diversify, what we are really saying is diversify across the board, diversify across stocks, diversify across market cap, diversify across sectors, diversify across investment styles, diversify across geographies. And eventually, I would say, to your final question, diversification even across asset classes is a good thing to do. Now, the main thing to remember is, why do you do diversification? Why do you do asset allocation? It is not to maximize returns. It is to increase the probability that you will stay invested during the entire journey. And because N is the most important factor, what you want to do is increase the odds that you will survive that journey of 20 years and 30 years. And diversification and asset allocation are two of the best tools that you can use to make sure that you are able to survive the volatility of the period and survive some unexpected things which can happen during your journey.
True.
So I would say these two are basically nothing but tools for increasing your longevity.
True. Thank you so much, sir. It was really insightful, and we'll share this conversation to the maximum number of investors possible.
Sure. Thank you. I
so much
hope
for
your
your time.
investors find it useful. Thank you.
Thank you so much.